So thank you for giving me this opportunity to educate you on this three-phase property game plan that we are going to be discussing. Right. So we will be discussing how property portfolios can be built successfully and how it can actually be leading to financial freedom or the passive income phase that people usually target as an outcome. Okay, perfect. So we'll get into the topic now. So a little bit about ourselves. So it is going to be myself and Deepak who will be presenting. So we have got a few team members within our team who are part of this webinar. But in terms of the presenter, it's going to be myself and Deepak here. So I'll start with my introduction and then I will be handing over to Deepak. So myself again, I came as a migrant to the country in July 2017. So it's almost we are completing 8 years now. So I'm having an IT background back from India. So I worked there for 10 years. Then when I came here for initial 5 to 6 years, I worked in IT. So back in 2020, mid 2020, when I completed 5 years in the country, there was a major car crash which actually turned me, which actually made this business possible. So it was an eye-opening moment for me when I was actually working in my 9 to 5, which was I was not liking. And while I was working in my 9 to 5, I built a bit of a portfolio by then, and then I never had that belief that I could be doing anything outside of IT because of the limiting beliefs. But then this accident made me think that I need to be doing things which I love doing rather than being pushed into things which I just got into after my graduation. Right. So as a result, I got into the accident in July 2022, and then this company was founded in November 2022. So I started preparing for all my certifications. Then we got this business registered in November 2022, and we have been working since then. And since April 2023, I'm running this business full time. So currently started as a solopreneur, but then Deepak soon after joined me, and then now we are a team of six and expanding. So a bit about my personal investing journey. I bought my first principal place of residence in mid 2019. After that, from January 2021 to June 2022, in 18 months, I ended up buying 7 investment properties, all while working in a 9 to 5. Current stage of my portfolio, and when I started business, as some of you may already know, that it is very difficult to get lending. So I had to pause for another 2 years, and then I made my three recent acquisitions in this financial year, which is about to end in next 1 week. So currently, my portfolio is standing at with 11 properties, and the value is sitting around $10.7 billion total, and it is expanding. So I'm again looking forward to our next purchase soon. Over to you, Deepak, for you. Okay, so a bit about where you can see me. So my story has been published in news.com.au in April 2023, like when I was in the transition phase from very young in my business, but then I was transitioning into a full-time role. This was the time when my story was published there. Recently, my story has also been published on realestate.com.au. I've been appearing in a few podcasts, and a few podcasts I am appearing in the next few months. So you can find my name on you can Google my name, and there should be a link to some of these podcasts. And if you are looking for any specific links, yeah, feel free to reach out. Over to you, Deepak.
So my background was I was working as a telecom engineer back in India. Then I moved in August 2016 and for search for a better lifestyle. Initially, I took some IT related odd jobs, but after a few years, I realized I wasn't satisfied with the work I was doing. So I joined InvestorAid as a buyer's agent, and since then I've been helping clients to secure property in the high growth market and where the cash flow is good as well. And since in past 2.5 years, I've secured like 70 to 80 properties all across the Australia, and that's it for me. Over to you, Rohit.
Yeah, perfect. Thank you, Deepak. So nearly we have by this time as a business combined, we would have secured 200 properties by now, and it's growing. Perfect. So we'll get into so a bit of a disclaimer, Deepak, again, over to
Yeah,
you.
no problem. Leave that. So if you want to read full disclaimer, it's on the screen, but I will read few lines which are important. The information provided in this webinar is for general informational purposes only and does not constitute financial, legal, tax, accounting, or property advice. It has not taken into account your individual objectives or personal circumstances. Before acting on any of the content, we strongly recommend seeking advice from a qualified and independent professional relevant to your situation. Thank you. Over to you. Let's move on.
Thank you. Thank you, Deepak. Yeah, so again, as we said, like this is just a general disclaimer. So we are not either legal advisors or professional financial advisors, right? So speak to your financial planner, accountant, or legal professionals in order to get written advice from them. So we are just professionals where we can help you grow wealth. But again, if you want to get any specific legal or accounting advice, seek professionals. And if you are not sure whom to reach out to us and we can refer you to some good ones. Okay, so before we move on to the topic, we want to just do a few polls to understand our audience better. So we'll run a few polls and see what our audience think. So we'll start with our poll number one. Okay, so how long do investors hold their investment properties? I think this is a bit short here, but the whole question is, how long do you think investors usually hold their investment properties? Okay, so more than half of us think that it is 5 to 10 years, which is completely right. Perfect. So we'll move to the next one. Okay, so this is again regarding the biggest pitfall. So what do you think is one of the biggest pitfall in building a property portfolio? Is it no clear strategy, buying too slowly, focusing only on cash flow yield, holding your poor performing properties too long, or not managing your cash flow properly? Yeah, okay. Perfect. So I think 75% of us has answered that no clear strategy, which is a fair answer. Yeah. So having a strategy is very important, which will briefly touch upon in our webinar. We'll go for the last one now, and then we'll move on. Okay. So do you have a clear plan to reduce debt or generate income from your property portfolio in the long run? Okay. So I think 50%. Okay. 13, 13 people have answered, and the biggest response that we have got is no. Okay. So this webinar is going to be covering a part of it again. Okay. So we will move on now. Thanks for providing the responses to the poll. This gives us a bit more clarity on whom we are talking to, and we can actually customize our webinar a bit in my education now. So we will now move to the learning aspect now. So the common pitfalls, as we were asking earlier, right? So common pitfalls that can hold your investment journey towards financial freedom, right? So you would see many investors start with the right intention. So everyone has got the intention that they want to be making money by investing property in real estate, right? But not everyone basically achieves that successfully. And you would see like 99% investors don't get past 2 or 3 properties. They get either stuck, or they feel the objectives that they were chasing are not being achieved, right? So here are some of the common pitfalls which we'll be discussing just for education purposes, right? The first one, as you answered earlier, was no clear strategy. So most of us clearly understand that having a strategy is very, very important, right? So buying, and it is very similar to anything in life and not just real estate, right? So whenever you're wanting to build a property portfolio, you should always, or wanting to buy properties with some objective, always think about your why. Always think about what are you wanting to achieve as an outcome from this investment, right? So people usually should always be starting with a goal in mind and then formulate a strategy to reach that goal. And each of your asset acquisition should be aligning to that strategy, so that each asset acquisition is taking you closer to your goal, right? You don't want to be in a position where you end up buying a few properties and they are interfering with each other, right? Okay, so understanding your why, your goals are very, very important. And then asset acquisition should always come later, because there is no one size fits all. Different people have got different objectives, and in order to meet those objectives, there are different strategies that you need to be adopting. The other common pitfall is that people want to be building a portfolio. They want to retire from this property, but they are just too slow in buying. They might have been making really good capital growth, but then they just don't use the equity timely enough, and they just keep waiting too long. So we have served multiple clients where they have made 50-70% capital growth in 2 years, but then in order to get to the next investment, some has actually waited a bit too long. And the downside of that is because if the other markets are rising, they just miss out on that capital growth opportunities, though they were financially ready with the deposit and also the borrowing capacity. So buying too slowly is again another common pitfall. We'll go to the next ones. So focusing only on cash flow and yield. So when you are buying a property, many people don't want to be having a lot of out-of-pocket expenses, right? So which is a very fair expectation. But just focusing on the cash flow or the yield perspective, you sometimes miss out on very critical aspect of investment, which is the capital growth. So cash flow is usually, so say for example, if you're taking a mortgage of 80-90% initially, even if a property is positively geared, it is not enough to make any significant impact to your lifestyle. It might be giving you 100, 150 bucks a week, which may not be either enough, right? So your target always is that a cash flow should always be for sustainability reason, but then you are chasing capital growth because capital growth is what makes you wealthy. Capital growth makes you wealthy and cash flow sustains you to the path to wealth. So both are equally important, but just focusing on cash flow and missing out on the capital growth aspect could be again a very big pitfall. The other common pitfall that I want to discuss is overcommitting early without managing borrowing capacity. And this is specifically referring to people like who have got, say, for example, $1 million borrowing capacity and they are just starting out. They just get into their first investment with that $1 million budget. And they are also, in sometimes, say, for example, if they end up buying something in Sydney or in any other expensive market, these markets would not only consume whole of their borrowing capacity, but the cash flow is may not be good enough for them to be able to sustain that long, or even if they can, it basically limits their ability to be able to buy more assets. So maxing out too soon could be one of the reasons. The other reason is, say for example, you know your borrowing capacity today, and that borrowing capacity may not be enough today for you to be uh, to be achieve your goal, right? So in that case, you can actually think about structuring. There are ways how you can speak to your accountant and financial planners and brokers regarding that. There are structures using which you can actually expand your borrowing capacity. So if you say, for example, if your objective is to buy 4 or 5 properties and your borrowing capacity at the moment is looking like that you can only buy two, then it is again very critical for you to be starting to think about how are you going to be structuring these purchases. So maxing out too soon or poor loan structures again is another pitfall. Okay, this is again very interesting one, man. I keep seeing this very often. So holding poor performing properties too long. So you would find sometimes properties which are not growing as much that you initially expected, or you might have made a purchase thinking that as an owner occupier purchase, and down the track you converted that into an investment, and you're just holding that off because of thinking that it might grow at some point. And in many cases I've seen for our clients that where they initially started with an apartment based in Sydney, which they bought as an owner occupier as their first home, and then they moved into a house and held that investment for next 5, 7, 10 years with the hope, because since they've already done the transaction, already paid stamp duty, they are thinking that this property, once it grows, then they'll sell it because they've already incurred the cost of acquiring the asset. And sometimes this can just be a very dead weight to your portfolio. So you could be holding a dead asset for, or when I say dead asset in terms of the capital growth, again, I'm referring to, it might be good in cash flow, but this asset not performing very well in comparison to how other assets in other markets are moving. So your 500, 700K thousand of borrowing capacity logged into an asset can be better utilized into a better asset type, into better locations in the markets which are favorable. Right. So sometimes holding poor performing assets for too long is again a very common pitfall. And it's not unusual. Like we keep seeing every day when we are talking to our clients. Again, no exit or passive income plan, right? So you want to be building a portfolio, but you now need to also understand your limit, your what you need to be putting timelines to the goals, like what your time frame looks like, right? Say, for example, you're looking to acquire build your portfolio, acquire X number of properties, but until when? After that, eventually you might want to retire on that, or you want to that property to be giving you some kind of income so that you can have different choices in life, or early choices in life, right? So having an exit strategy or a passive income plan is again very important. And then underestimating the cost. Okay, so this is again very important because it's not just the mortgage that is your actual cost. You have to be adding the council rates, the land tax, the insurance, the repairs, and the property management, and all other extra expenses of owning the property. Because a property which might look to you as good cash flow may still be heavily negatively geared if you start adding all of them up, right? So doing a cash flow analysis before you make a purchase and making sure that that fits with your overall plans is again super crucial. And then the last one, again, not managing your cash flow properly. Okay, so this is again going back to the previous point that I was talking about. So you need to be managing your cash flow while you're holding the asset. So as I said earlier, capital growth is going to make you wealthy, but you need to have at least the sufficient cash flow to be able to hold that asset. Because if your cash flow becomes a problem, that will force you to sell the asset sooner, which may mean that even if the property is giving you a potential for capital growth, you would still miss out on capital growth because you were not able to hold that asset long enough in order to achieve that capital growth. So cash flow again is crucial, because if you are wanting to buy a few properties and you want to hold them long enough, you need to manage your cash flow properly. So these are the common 8 pitfalls which I wanted to basically highlight you on. Okay, so now let's break the myth, right? So when we say that purchasing a property leads you to passive income or early retirement, and it is a very common objective why people invest in real estate, right? But then they end up buying a property and think this is going to get them this particular outcome, right? So a single property or even two properties may not be enough for you to give that passive income or early retirement goals, right? Again, depending upon how big of these goals are, what numbers are we talking? But again, in general, 1 to 2 properties are not enough for you to be getting that passive income, or at least in soon enough, right? So because if you buy a property, right, usually the loan term is 30 years old, and let's assume that your tenant is paying it off, it will still take 20 to 30 years unless you are paying higher principals, right? So it will take 20 to 30 years for the loan to be paid back. And for a property to be generating passive income, it needs to, the rate level has to be drastically low, or it has to be zero for you to be generating passive income out of it, right? Or like even if you get the debt levels to 50%, the passive income may not be strong enough, right? So your goal is that you want these assets to be as much debt free as possible as soon as possible, right? So if you want a property to, as I said, like if you want a property to provide considerable passive income, it needs to be largely or fully paid off. So even if it is self-sustaining, it may take 15 to 20 years to pay off using rental income, which is a very, very slow process, right? So if you want two properties, you also need to save two deposits, right? So okay, so we'll move on to the next one. So there is a smarter way here where you can buy a property with short-term capital growth target, and then use the equity through the short-term gains that you have got, use that equity to buy your property number two, right? And then but the problem with these, even with this strategy, is though you have acquired two assets soon enough, because for the second asset, the deposit, you are not getting it from your pocket, and you have actually taken help from your property number one to fund you the deposit. But holding again these assets just by themselves, and letting the tenant pay off the mortgage, it is still again 15-20 years process for you to be starting to generate significant passive income from these properties, right? So there is a better strategy which we call a three-phase bulletproof strategy here, right? Which is we'll be talking about here, right? So, and this three-phase is very similar to bodybuilding. So I've just done an analogy here to basically educate you again and make it understand in a better manner. So the first phase of property portfolio building is acquisition. It is very similar to bodybuilding, like bulking phase. Property acquisition phase is where you want to acquire as many assets possible, as hard as possible, uh, and as soon as possible, so that you are acquiring them assets by timing the market correctly and then giving them enough market time to grow. So acquisition phase is like bulking phase. Then we get, and I'll be elaborating a bit or more onto this in the subsequent slides. And then we have got a consolidation phase, which is a leaning phase, where you start cutting the waste, where you start basically getting rid of, say, for example, you ended up buying 5, 7, 10 properties. You then start liquidating a few of them where either you think they have done their job and you don't see significant benefit of holding them long enough, or that is probably one of the least desirable out of your whole portfolio, right? You want to be picking them up and then sell them and reduce your debt levels, and that is called consolidation phase, which basically then leads you to retirement phase, right? Retirement phase is just the maintenance phase where you're enjoying your passive income, and then you then have got your choices in life. Using this passive income, you can continue to do whatever you love to do rather than being forced to do things like I was doing in my IT, which I was not liking, but I had to pay my bills and I was doing that. Okay, so we'll now elaborate more on the first phase of the acquisition phase. So in the acquisition phase, as I said, we want to go as hard as possible and as fast as possible. So I'm taking an example here for better understanding. So say, for example, if it was me and my goal was to buy 5 properties in 10 years, my acquisition phase time period was 10 years, and my goal was to buy 5 properties, and let's assume they were around 600,000 each, right? So buying one property every 2 years is not the right strategy. The reason is because towards the tail end of this 10 years, you would see property number 4 and 5 have not been given enough or any time at all for growth. So you want a better strategy where you are first acquiring them in the initial part of your journey, like acquiring them as soon as possible, and then giving them enough time to grow, right? So buying all 5 properties in the first 2, 3 years with short-term capital growth target helps you build equity in the initially purchased asset, which can then be used to equity to fund the deposit for the next ones, right? So say, for example, you buy your property number 1 today, your target is short-term capital growth. You may not need to wait another 2 years to buy your next one. If your property generates enough equity, you can then start rolling into the next one soon enough. And then if you again target that with short-term capital growth, by the time you reach to third one, you may have some more equity in property number 1 plus some equity in property number 2, and that way you can start building your portfolio. So with the short-term capital growth target, you might want to acquire these 5 assets in the initial 3 years, if possible. Like again, 3 year is just a term for explanation. Like it could be 2.5 years or 5 years for different folks, right? This is just an example. So initially you want to be focusing on market cycle timing, because focusing on market cycle timing, you can target short-term capital growth, right? And then using that short-term capital growth, you are taking that equity out and then using that as a deposit to buy the next ones, and then give these properties enough time for all of them for them to grow. In this example, we have bought 5 assets, and then we have given them at least 7 years. Like even for the last ones, the first ones are given even longer for them to actually grow. So you are focusing not only timing the market, you are also focusing on time in the market. So you are timing the market when you are acquiring the assets, but then you are giving them enough time in the market for them to grow, and let the time do the magic. So, and again, this is just an example to make it understand, like this is again going to be different for different people depending upon so many factors like their income levels, their goals, their targets, and whatnot. So, and then timing the market, it's a bit more elaborating on that. So timing the market. So it's not just waiting for the time in the market, you are timing the market to get that short-term equity growth. And this is just an example where you bought one property, sure, you got short-term equity gains, and then using that, the equity is used as a deposit to buy the next one, assuming you have got the borrowing capacity. So again, bottom line is, in acquisition phase, you want to go as fast as possible and as hard as possible. And the goal is to build the base of your portfolio quickly so that you can let the time do its magic to give you the growth. And the second phase is the consolidation phase. So consolidation phase is the phase where, say, for example, once your property portfolio has grown significantly or nearly doubled, right? Which is not unusual for if you're holding good assets in the right markets for 10 years. You may plan to sell some of those properties and reduce or repay your debt completely, right? Again, different for different people, it could be different, but I'm again trying to explain it using the same example for better understanding. So say, for example, this couple who has bought these 5 properties in the initial 3 years, and then by the end of the 10th year, these properties have doubled, right? So what they can essentially do is one of the many solutions here, right? One of the many solutions is they sell 3 of those properties let's assume one of the capital gains cover, sorry, one of the capital gains from one of the property covers the capital gain or your ATU liabilities for even other two properties, right? Then you have got two properties which are paying the debt for the other one. Let's assume these are interest only for ease of calculation, and they were priced similarly, right? So you have sold three properties, you have made good capital gains. One of the gains are liquidated in your ATO capital gain taxes. The other two gains are then used to pay off the debt on the other two assets that you are holding. Then in this consolidation phase, you are left with two properties completely debt free. And this will basically take you to the third phase, which is going to be passive income phase. Right? This is again just a graphical representation. So again, third phase is the retirement phase or passive income phase. So you have sold three assets, you have retained the two, nearly debt-free or debt-free. Now you have got two debt-free assets generating you income. So let's assume these properties were initially bought at $600,000 and these properties have doubled in 10 years to $1.2 million. So you have sold three of them, you have retained only two. So your portfolio value is sitting around $2.4 million now in 10 years time, completely paid off. So at 5% rental yield, you are looking at around 120 passive income gross. Again, there are going to be expenses on top, but yeah, this is just a gross passive income. At 4%, it is going to be around $96,000. Okay, so this is again the same pictorial representation telling you that this is how you usually get to the passive income goal. So you want to be first building a portfolio, acquire properties as fast as possible, as hard as possible, and then through consolidation, you reduce the debt levels, and then you enjoy the passive income that the property portfolio or the remaining property portfolio brings to you. This is just an example of a couple who is Prabhat and Ashwani. So for this couple, they are based in Doonside in Sydney. They have got their principal place of residence. We have bought these four properties for them in 9 months. So these properties were bought, you can see the time frame in October 2023. Current value sitting at, this was bought at 493. Current value sitting at 687. So 39.4 capital growth in 18 months. So for this client, 9 months after this, so for him, the acquisition phase initially was 9 months. So his phase is not finished yet. He just got stuck with the borrowing capacity issues because of his the work he does. But this guy will get into, again, the second spell of the acquisition phase soon. But for this guy, his initial acquisition phase was 9 months. And then 9 months after the last purchase, the total equity that he has made in terms of the bank valuation came to 694. So he has got enough equity. So he just need to be sorting out his borrowing capacity to be able to continue to build this portfolio. Because usually people take their acquisition phase to 5, 7, 10 years, again, depending upon your age and the financial outcome that you're wanting to achieve out of that. So yeah, this is the overall learning. So I'm more than happy to entertain any questions that you may have. So do you have any questions, Deepak, in the chat?
I got one, but I couldn't understand it. So it said that you recommend not to buy the first property with cash flow, but focus on equity growth. I think.
Okay. So I've got this question. So what? No, I'm not saying that. I'm not recommending that. I'm recommending for your initial few purchases, you have to be focusing on capital growth as well as cash flow together, and you can do that. Because see, I've done this my webinar number one on exactly the same topic. So on my YouTube channel, there should be a recording available there, or you can get in touch with us where we can provide you that. So focus on capital growth as well as cash flow together, right? And you can do that. The reason is because capital growth is needed because will be helping you with the equity for the second one, and cash flow will help you in multiple ways. The first benefit with good cash flow properties is that they will be helping you in your serviceability. A poor yielding property decreases your borrowing capacity versus a good cash flow property helps you in your serviceability because cash flow from the property gets added to your household income in order to service the debt. So good cash flow means better borrowing capacity. So you should be targeting both. Okay.
Yeah. And
Yeah.
there's Rohit, another question. Do people normally buy in trust first when buying the initial few purchases?
Okay. So there are a few things there, right? A few considerations. So Your property number one can be in trust. Again, I don't want to be giving you any financial accounting advice. Speak to your accountant, but I can just tell you a basic tips and tricks, right? For trust, I'm referring to family discretionary trust here. So these trusts in different states have got different land tax thresholds, right? So you need to be mindful. Say, for example, if you end up buying your property number one in NSW, you may not want to go under trust. The reason is because land tax threshold becomes $0 in comparison to if you were buying under a personal name, it is over $1 million, right? Especially for investment. PPORs are exempted here. So when you are buying under a trust, it depends upon a few factors. First thing, which state you are buying in, because the land tax thresholds. The second question, the second consideration here is that how much borrowing capacity have you got? Because using trust structures, you can actually retain your borrowing capacity. So how, again, with specific lenders, speak to your broker regarding that. But depending how much borrowing capacity you have got, what your plans are. Say, for example, if you have got a $2 million borrowing capacity and your plan is to buy only two $1 million properties, then you may not want to bother going for trust at all. But if your borrowing capacity is $1 million and you want to build a portfolio of $3 million, then trust becomes a consideration and could be a game changer. And then you need to line up your purchases according to which state you then end up choosing, because not every state is favorable for trust. Hope that helps.
Yeah, I think thanks. So the next question we have, what are the parameter to decide number of properties and duration during acquisition phase?
Okay, so parameter, again, everything starts with your goal in mind, right? You want to start first thing, what are your goals? Like what kind of passive income are you targeting? Because that will determine a few things there, but that is just the starting point. Then you also need to look at your current financial situation and speak to your broker on what you can afford, right? So say, for example, if I'm doing an Uber driving, for example, right? And my income is only 40,000 for the year, and I'm the sole earner in the family, but my income is to build 15 million portfolio in next 5 years, then it might be a very difficult journey for me, right? So always start with a goal and then look at your current earnings and see if there is a way for you to, and if it doesn't map correctly, then is there a way for you to actually enhance that? And then you can start working towards it. So in terms of number of parameters for property, number of properties, I wouldn't classify it more in terms of number of properties, because you don't want to be stacking cheapies, right? If you know what I mean. You want to be buying properties with a good cash flow, with not just good cash flow, but good potential, right? Capital growth as well as cash flow. So rather than buying 7 properties in 10 years, you might want to just buy 4, right? But you want to be buying good assets when you're acquiring. So I keep hearing this all the time, where people just want to compromise in terms of the purchase price and also the asset for the current one so that they can buy their next one sooner. And it should never happen that way. When you are acquiring your assets, you want to do it sooner, but you don't want to be acquiring compromised assets, because it will again be impacting the outcome, what you're wanting to achieve. So duration usually, as I said, like it depends upon a few factors, depending upon your age, at what age are you wanting to retire. So someone who is in 30s want to retire at 50s, their acquisition phase can be much longer in comparison to someone starting at 45 and they want to retire at 55, right? So basically on a few parameters. Hope that helps. Yeah.
Yeah, the next question we have over here, right? Best outcome is in the lower price range. What about someone who has no principal place? What is the best way?
Okay. So someone who hasn't got a principal place of residence, there again, someone has not got a principal place of residence. Is it out of choice because where they want to live, they can't afford to buy there, and that's why they went to the route of rent vesting? If that is the case, then they can continue on that. They can continue on that, because not always, see, again, buying a principal place of residence is like buying a Ferrari. It may not be the best financial decision, but you are feeding the emotional aspects of your life, right? Your family. So buying an investment property is a financial decision, right? So I'm not saying buying a Ferrari is wrong, right? It may not be the best financial decision, but if you love that, then there is, yeah, people do it, right? So principal place of residence could be like that. There are definitely some tax advantages there, but usually principal place of residence purchases are more of an emotional purchase than anything else. People may make capital growth, people may make that tax-free capital growth, but usually that's not what the intention is when they are making that PPR purchase. So I think someone who hasn't got a principal place of residence, they can continue to rent west. Like I've got so many clients of mine, even some of my past colleagues, who have never ever bought any property in Australia for their living purpose. They're renting and they build significant portfolios. They're just buying one after the other because here they are then not restricting themselves to the geography that they are living in, so they can take the best advantage of wherever. Like if today there is a market which is 2000 kilometers away, which provides you best potential, you invest there. Down the track, if there is another market 2 years later which is 4000 kilometers away from, you keep investing there, right? So you then start investing based on market cycle timings and kept tapping into the best markets whenever you are ready for the purchase. Hope that answers the question.
Yeah, I think the next one I have, do you recommend buying properties that are 30 plus years in age as your first IP, say something built in 1995?
Yeah, I wouldn't mind. See, I built my whole portfolio in 70, 80 years property and 70 years old properties. Some of my recent acquisitions have been newer, but age of the property, I wouldn't be too mindful of. I am, I wouldn't be really worried about the age. The thing is, a property age doesn't determine their capital growth. I understand their maintenances could be a bit lower on newer properties, but also understand a property structure lasts forever. They last for 100 years, right? It's the fixtures in the property that have got their own lifespan. So say, for example, if you end up buying a property which is 10 years old, but where the lifespan of a carpet is 5, 7 years, has not never been replaced. Air cons, 5, 7 years lifespan, have never been replaced. A 10-year-old property is going to cost you a lot more than a 40-year-old property where this was done 3 years ago, right? So each fixture has got its own lifespan. So more than the property, I would look at the condition and the bones and the structure of the property and in the market that I'm tapping into. So some of the 40, 50-year-old property are much more solid and robust than something which is 5, 10-year-old. So I wouldn't be really focusing on the age. I would be like, if it is your first purchase, go in a market where it presents very strong fundamentals for growth.
Yeah, makes sense. Next one I have, Rohit. Is it practically possible for someone to buy 4 properties in 5 years as a solo owner?
Yeah, see, again, depending on a few factors here, right? Again, as a solo earner, how much are you earning? First thing. Second thing, like if you are, as I said earlier, right? If you are short on your borrowing capacity, understand your goals, understand your current financial situation, and then start planning. So, say for example, if someone is a solo earner and earning 50 grand versus a solo earner earning 200 grand, their outcomes, like their capacity would be very different, right? So you need to understand what you are wanting to do. If your current income permits, then you should be able to do that even buying under personal names. But if that doesn't permit, then you can use some structuring techniques in order to expand your portfolio further. But when you are a single earner, just make sure when you are a single earner, make sure you are focusing a bit more on cash flow than the other aspects, because your disposable income may not be as high, right? You already have got recurring expenses. You want to target good capital growth opportunities, but also need to be very mindful of your cash flow, because if you are buying 5 properties, each property is costing you 4 grand to hold, your overall expense could still be 20 grand for 5 properties, which is still okay. But if you are buying something which heavy negatively geared, though the capital growth is good, then it will again stall you. So just need to be a bit more mindful. Okay, so work with an accountant first before engaging a buyer's agent.
I think that's the following up
Okay.
question.
Yeah, see, I think, yeah, you definitely need to be working with your accountant, but before that, you need to be working with the mortgage broker. You need to be speaking to them, understand how much can you borrow, understand what your goals are. You can speak to a buyer's agent as well. You can speak to a buyer's agent, understand there, because buyer's agent also will not be taking you on board unless he has got these things figured out. All good buyer's agents do that, right? So if you are reaching out to a buyer's agent, they won't take your signups. They'll first ask you, have you got the borrowing capacity checked? Have you got it pre-approved, right? And then they will also be understanding, like as part of our discovery call, the last question that we have on our discovery call is, regardless of what people say they want to do, we want to understand what they want to achieve as a real estate goal or as an outcome. Because sometimes there is a misalignment on what they think they need to achieve in order to achieve their goal. So in that case, my recommendation is, you can speak to a buyer's agent first, then they can discuss regarding your goals. Then you get in touch with your broker, understand your current financial capacity, and then we can discuss whether that can help you achieve. And if there is a need of structuring, then you get to the accountant who can then help you, give you all the right advices. And then as a team, we work together and help you achieve the best outcome. Hope that helps. Yeah. Okay, so this is just a thanks. Anything else?
Not really. I think that's the last
There
question.
was a question. So Harish Bala has said that he has got a question. So Harish, if you want to unmute and ask that question in person, I'm more than happy for you to do that.
Sure, thanks, Rohit. Just a quick question. When someone buys property in Australia for investment purposes,
Yep.
Do the banks or the lenders consider their portfolio overseas? For example, if someone has, let's say, a couple of assets in Dubai, for example, and there's a lot of equity in there,
Yep.
or there is a lot of cash flow coming in there, would it be possible for that person to engage with a mortgage broker in Australia and get mortgage for investment in Australia?
This is a tricky one. I think mortgage broker and a tax accountant could advise you better on that than me, because it depends upon again a few factors. Like if you have declared your foreign income and you are paying taxes here, then I don't see a reason why that cannot be considered as an income, right? But this is just my layman understanding. A broker or an accountant can confirm you better on that. Usually they don't look at so much of an asset and liabilities. Again, my brief understanding says that, but I could be wrong here. So I think speak to a broker and an accountant. I think more to a broker than an accountant on this, because they are very much familiar on what the lender's policies are. The accountant can actually help. Sorry, the broker can help you confirm. Because I'm sure not all lenders would be entertaining, but there could be some lenders who might be willing to, but then they may have some prerequisites for that.
Thank you.
Yep, no problems. Thank you, Harish. See, if anybody else have got any questions, I'm more than
That's one question came from Suresh. I'm not sure whether how we can answer. A new to Sydney, recently moved at 72. Would like to know how can you advise a person like me from your experience?
new to Sydney, moved at 72. Would you like to know how you can advise a person like me from your experience? Okay. So see, again, for someone like yourself, my recommendation is speak to a broker, first understanding, because real estate or portfolio building is a game of finance, right? Doesn't matter how desirable I am, if my financial capacity or the lending doesn't permit me, I cannot do anything, right? So I think speak to the broker, because I'm not very familiar with the lending laws, how much mortgage and what time frame mortgages can you get at this stage. But again, if you are coming at 72 and have got some deposit, and if you are capable of making purchases, there is a potential to make money. But usually I think in real estate, the biggest power that we have got is the power of leverage, right? So you first need to understand what power of leverage have you got based on your current circumstances. So speak to a broker again for that. And that is my best advice to you. They will assess your situation and assess what deposits, what you're wanting to do, and how much of disposable income, and what the lending laws are for someone like yourself.
Yeah, I
Okay.
think that
Otherwise,
was the
answered,
yeah
expat income can be considered. Yeah. Okay.
yeah, that's the last question we have it. I think that is it. I believe we don't have any question in the chat window.
Okay, they have answered again. So the answer is likely no. I was declined to use my Anzac equity. Yeah, see, there could be ways you basically where you go to your overseas bank, take that equity out there, and then transfer those funds there, then use that as a local deposit. But again, getting an Australian bank to get your equity from your overseas property, because they are not taking this as a collateral, right? So it's going to be very complex game. Yeah. So I think you're right. Yeah. Any questions from anyone? Like I'm happy for people to just jump on the mic and start asking.
I think there's one thing, Rohit, Suresh is asking that. So you suggest to speak to a broker. Any recommendation for brokers? I think we can recommend some. Yeah, we know.
We can recommend. Just reach out to us and we can. We have got a very good broker here, Madhu, who's in the webinar. You can also reach out to her. She's quite experienced. So you can reach out to Madhu. So Madhu, if you can share your number and email ID here in the group chat, then Suresh might be able to reach out to you. Yep. Anything else, guys, from anyone?
No, we'll give a, like a few 1 minute, and after that, I think we can call it the end to this wonderful webinar.
Yep. Anything from anyone? I'm more than happy to answer any random questions that you guys have. I was down with flu today. I was not sure whether I would be able to do it nicely, but yeah, people give me energy.
Now, real estate, you can talk in your sleep itself.
Oh man, yes, people give us energy. All good, guys. Anything from anyone? Any questions? What stage do you suggest going into commercial properties? Okay. Okay, so this is again interesting one. See, again, different people have got different viewpoints. I'll just give you my viewpoint. Wouldn't say it is right or wrong. My recommendation is usually again, not saying like there are definitely exceptions. Usually, real estate is the capital growth assets where you can do without being creative, by with just market cycle timing. You can have big capital growth, and then once you have acquired your portfolio of whatever X number of properties, then you start mapping into tapping into commercial. The reason is for commercial, the barrier of entry is higher. They need you to pay larger deposits, right? So in order for you to have larger deposit, the equities from these real estate purchases, sorry, residential real estate purchases, basically support you. So usually people first build their residential portfolio and then go for commercial. But again, there is no one size fits all. There could be someone like we were having like Suresh, right, who might have a larger deposit, but he don't want to get into a mortgage or any financial burden, and he might just want to use that larger deposit to buy a commercial so that he starts receiving some passive income from day one, right? So for someone like him, commercial could be the best one, right? But for usual mom and dad investors who are starting probably in their 20s, 30s, 40s, then they first want to be tapping into the residential, build equity faster, then use that equity to tap into commercial. But again, in commercial, you need to be mindful that commercial assets, again, if you are not creative, they are not big capital growth assets. They are usually bit more cash flow. So in commercial, you also need to be aware that if the yields are too low, so in if you are getting, see, to me again, I could be completely wrong, but to me commercial doesn't make sense if it is giving me 5% yield and the interest rate is a 6%, right? Because the whole debt is always sitting on me to be paying off. I want the property to be actually taking care of a little bit of principal, if not completely, for and helping me pay off the debt faster. So in commercial, but again, there is another concept where you're with the rising rents, because once you lock your debt, your rent's rising, so your yields keep improving. But again, 3-4% CPI may not be enough, or may take too long for it to grow.
Correct.
In
Yeah.
commercial, there are strategies where you can actually buy probably partially occupied complex where you can basically renovate and get rental uplift, because commercial properties, the prices are always a factor of the rental that they are receiving. So if you buy something with a low rental, you would be acquiring that at a lower price. And then if there is an opportunity for you to bump the rent up through, if it is partially occupied, or say for example you got a property in a bad shape, you renovate and then get a tenant at a higher rate, that way you can do a very good value uplift. But you have to be creative in commercial to have that capital uplift usually. Hope that helps.
Yeah, right. I got another question. I think that can be done, I believe. I have a paid house. Can I buy a house for my son, used equity?
Yeah, 100%.
Yeah.
This is very common theme that people have, right?
Yeah.
See, what you do with your equity, nobody cares. Honestly, like there could be lenders like, but up to a certain extent, they really don't mind. So there are so many people who see, again, mortgage broker can guide you better, but taking an equity out, giving that as a gift to your kid, and then they using that as a deposit to buy
Yeah.
property would be a way. But again, a broker can guide you much better on that.
Yeah. Yeah. And I think that is more of like a. There's another question Harish posted. What percent of property is considered a good cash flow?
See, in residential, it is always gross cash flow. So gross cash flow, when we are talking 5.5% is actually considered very good cash flow. But again, you still need to understand that is going to be negative.
Negative, yeah. Net yield would be different.
100%. Net yield will be even lower, and if your interest rate is sitting at almost 6% or 5.5%, you are still negative. But always understand, like, cash flow shouldn't be the just, like I'm saying, that is important, crucial, but shouldn't be the only deciding factor. Because say, for example, in the current times, right, whenever you are acquiring an asset, today what you see is going to be the worst case cash flow position, right? Because from here, the interest rate is expected to drop. If you're investing in the right markets, the rentals are rising, which means your cash flow is going to get better from here. My properties, which I've acquired at 6% yields, are now touching 10% without me even putting a single cent in renovations, right? I've not done anything there. The rents kept rising, and with the interest rate drops now, again, you would see better cash flow into your pocket, into or out of your pocket, but better cash flow equation. Anything else, guys, from anyone? Yeah, thanks
So
again.
I think that should be okay. Yeah.
Is that okay? So we'll probably give people a minute if somebody wants to jump in and ask anything. Otherwise, we will just move on to the next step. So this is, so if anybody needs help in their investment journey, we are a real estate buyers agents. We have nearly bought 200 properties now. We have got multiple clients for whom we have bought four plus properties in last 12, 18 months. So if you are looking for a help, yeah, you can book a discovery call and we can go from there.